Hi, and welcome to Business Advisory and Tax Tips. Today we'll be talking about the stimulus update and also 3 tips to think about when reevaluating your business entity structure. But first, I'm Michelle Burke, coming to you live from Annapolis, Maryland. Many of you know that after 30 years in the corporate tax world, I went out on my own in January and formed Health and Taxes. There are only 2 things certain in life, death and taxes. I'm here to help you flip that to health and taxes. I provide business advisory, growth and wellness advice to business owners seeking to increase their growth or profitability. But first, I come to you live every Wednesday at 5 p.m. Eastern Time to bring you stimulus update and some business advice or tax tips. So today, we're going to jump right in and talk about what's going on the Hill. So many of you probably heard that Nancy Pelosi did get reelected in the House as the Speaker of the House. That wasn't expected. That was definitely expected, but there were some younger Democrats saying that they wanted to see a change, but she did get pushed back. She did get reelected. So what I'm hearing from the House is that they are back to wanting a $2.2 trillion package, looking at the HEROES Act 2.0 that we talked about earlier this year. Hi, Julie. Thanks for joining. And that Nancy wrote a letter to Mitch McConnell today stating that she's ready to negotiate, been ready to negotiate, and she just wants him to come sit down with her and start that negotiation. What we're hearing from the Senate side is that Mitch McConnell is saying that he's down to a $500 billion bill again. He's looking just to fund schools, another PPP, liability protection reform, and funds for healthcare, funds for the healthcare workers. That has no stimulus in it for the everyday taxpayer. That said, other Republicans have come forth in the Senate and said that they want more than that, and that they're ready to negotiate. So we just keep hearing that everybody's ready to negotiate, but no action is being taken and no actual negotiating is happening. We do know that the government spending bill needs to be passed. So that is probably the first priority, but getting back to the taxpayers and getting back to a stimulus is definitely a high priority. So some of the governors have been joining together. Yeah, I know, shocking. Yeah, the House had already passed, you're right, Julie, the HEROES Act 2.0. The Senate has actually not passed anything yet. They've drafted several bills, including the skinny bill and the HEALS Act, but they have not passed anything. So we'll have to see. So anyway, a bunch of governors have come together, on both parties, and they're putting pressure on Congress to pass something. And meanwhile, the Colorado governor came out today and said he's tired of waiting. He's going to take matters into his own hands and find a way to help people in need in the state of Colorado. So more of that might be happening, but we know that there's a request for funding for a lot of the state and local governments in some of these bills, and that's been one of the sticking points. So some states may have the funding and other states don't. So no meaningful developments at this point. So sorry to say that's all I have for you today on the stimulus, but stay tuned. I'll keep updating you, and hopefully we'll see if we can find anything before the end of the year. Julie, as far as the fiscal budget, they are working on it, and it is the top priority. So yes, it is set to expire December 10th. I don't know. If nothing else, it'll probably at least be extended again. So they are working on it. Hopefully they'll get it balanced. I'm sure with the Senate being uncertain with the runoff elections in Georgia, that there's some concern that Republicans might want to push and get that government budget through this year, instead of waiting to January to see what happens with the Senate runoff. So we'll see. Keep you posted on that as well. So then my second topic today, I wanted to, as we go into year end and some of the small businesses out there should be thinking about year end planning and thinking about planning next year. And one of the things typically I encourage businesses to do is to reevaluate their business structure. So last week we talked about the Tax Cuts and Jobs Act, or at least it's known as that, the TCJA, as I'll call it. And I talked about that last week, and you can go back and watch my YouTube on that with the Biden policy and a kind of a summary of the existing current tax policy. But as a reminder, corporations have a 21% federal rate for C corporations under that law. So that's post 2018 and later. C Corps previously had a 35% tax rate. That Tax Act also reduced the individual rates, which also applies then to sole proprietors and pass-through entities such as partnerships, S Corps, and typically LLCs. The top rate there dropped slightly from 39.6% to 37%. So you think, okay, corps now have a 21% rate. Maybe that's the best way that I should have my business formed. However, it's just not that simple. So conventional wisdom before 2018 said that most small businesses should be set up as a sole proprietorship or pass-through entity to avoid the double taxation of a C Corp. A C Corp pays entity level tax, and then as it pays its shareholder dividends, the dividends are taxable to the shareholder, as well as capital gains when the shareholders sell their stock. For pass-through entities, there's no federal income at the entity level, so just a one-level tax. So conventional wisdom prior to this Tax Act had been to always suggest small businesses setting up as a pass-through entity versus a C Corp. So with this new 21% rate that's been in effect the last couple of years, is the answer that simple? And the answer is no. So especially given that that act also gave qualified small businesses a 20% qualified business income deduction, which is really helpful. There's a lot of limitations on that, but it's really helpful and keeps those pass-through entities as a viable at a viable rate if you take into consideration that large deduction. But that will expire in 2025. So that's set to sunset unless some further action is taken. So again, there's no simple answer. The best choice for your business is always going to be unique and based off your personal experience, personal business. However, there are 3 tips or 3 things I'd like to share with you. One, if your business generates tax losses. So for a business that consistently generates tax losses, there's no tax advantage as operating as a C Corp. Losses from C Corp can't be deducted by their owners. A pass-through entity will generally make more sense because losses pass through onto the personal tax returns. So that's first and foremost, businesses generating tax losses. Second, number 2, business distributes all of its profits to its owners. I see this frequently in S Corps and partnerships where the business is set up and the intention is to pass all all excess income and distribute it all to its owners. So for a profitable business that pays out all of its income to the owners, operating as a pass-through entity, generally it's better, given the significant deductions from the qualified business income, to operate as a pass-through entity. Now, if for some reason there's limitations on that QBI deduction, then there might be a circumstance where a C Corp could be better. But generally, if you're passing all your income over to the owner as a distribution, it's more beneficial to be a pass-through entity. And then third and finally, if a business is planning to retain all of its profits to finance growth, this may be a situation where a C Corp makes more sense. So where a business that's profitable but holds on to its profits to fund future growth strategies, operating as a C Corp could be advantageous if the Corp is a qualified small business. Why is that? That's because there's 100% gain exclusion that may be available for that qualified stock sale gains. So that's something you want to look at. So there's a certain limitation on what is a small business and what is qualified stock, but it has that advantage with regards to the sale of stock and how the capital gains are treated. So those are my 3 tips for today. And again, there's a lot to be considered in going into that entity formation and things to be thinking about. But those are 3 things that are common that you should be thinking about. Of course, a lot of us aren't thinking about generating losses, and it just comes to be that way. So perhaps if you were a C Corp and you're not quite doing as well as you thought, it might, and you're continuing to produce losses, it might be a good time to change it up and elect to be an S Corp. Anyway, if you need help in evaluating how best to structure yourself, please reach out. I'm happy to give you some tax tips and my opinions on that. So thanks everyone for joining me. Please put any comments below. If you're watching this on Facebook Live or in the replay, please comment, like, or share. If you are catching this in replay, also please go onto my YouTube channel and I'll post that below. Please like and subscribe if you enjoy these and would like to be notified for the next one. Otherwise, I will see you next Wednesday at 5 p.m. Eastern with more updates on the stimulus, as well as some additional tax tips or business advice. Have a good night. Bye-bye.